The long-term survival of a speculative account is determined not by the accuracy of the entry signal, but by the discipline applied to position sizing. For the professional operating within the Wyckoff framework, position sizing is the ultimate mechanism of capital preservation, translating high-probability structural analysis into quantified manageable risk. The method identifies specific points where supply has been definitively absorbed or demand has been exhausted, providing the logical, narrow boundary required for optimized risk calculation. Before continuing, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this content to more people. The professional trader's primary objective is the preservation of capital, not the maximization of immediate short-term profit. This mandate places risk management above all other considerations in the hierarchy of trading decisions. Profit maximization is a secondary consequence of sound risk control. If the capital base is eroded by undisciplined exposure, the capacity to participate in high-probability moves is fundamentally impaired. Position sizing is the mechanism that rigorously enforces this mandate by limiting the total exposure to any single adverse market movement. It acts as the financial firewall, ensuring that even a series of losing trades, which are inevitable in speculation, cannot critically damage the overall trading account. The professional understands that the consistency of the risk unit is the key to maintaining a positive long-term trading expectancy. Wyckoff's methodology provides a unique advantage in this calculation. By identifying the phases of accumulation and distribution, the trader can pinpoint moments where the professional money, or the composite operator, has completed its testing activity. These points, the low of the selling climax, the high of the automatic reaction, the low of the spring, or the high of the upthrust, are not arbitrary statistical levels. They are structural markers of supply and demand absorption. When the professional identifies a successful test of the supply, such as the low established by the spring, the distance between the entry price and the structural low is the minimum possible logical risk. This tight, structurally defined stop-loss placement is what optimizes the position size calculation. A tighter stop, derived from a confirmed Wyckoff structure, allows for a larger number of shares or contracts to be purchased while keeping the monetary risk fixed and acceptable. Defining risk within the Wyckoff framework is fundamentally different from purely statistical approaches. Risk is not simply a measure of historical price volatility. Instead, it is a measure of the probability that the professional money has exited the position or, more critically, that the anticipated structural move has definitively failed. A stop-loss placement must therefore be logical. It must be placed at a price level where, if breached, the structural integrity of the entire accumulation or distribution scheme is invalidated. If a trader anticipates a move up based on a period of accumulation, and the price subsequently breaks decisively below the low of the selling climax, the thesis of accumulation is broken. That price point, or slightly below it, is the only logical place for the stop. Placing the stop closer, based purely on a desire for a smaller position size, risks being shaken out by the composite operator's final maneuvers, which are designed precisely to absorb weak positions before the markup begins. Placing the stop too far away violates the capital preservation mandate. The concept of the trading range is central to defining and containing risk. Risk is contained within the boundaries of the established accumulation or distribution range until a definitive break occurs. The boundaries, the preliminary supply or support, the selling climax, the automatic reaction, the secondary test highs and lows, define the maximum potential volatility that the professional trader must endure while the cause is being built. The position size must be calculated based on the distance to the structural boundary, acknowledging that any price movement remaining within the established range is merely part of the ongoing process of absorption or distribution, and not yet an invalidation of the long-term thesis. The application of Wyckoff's three fundamental laws provides the theoretical basis for adjusting and optimizing position size dynamically throughout the trading range. The first is the law of supply and demand. This law dictates the immediate market condition and informs the confidence level of the entry. Position size must be adjusted based on the observed imbalance between supply and demand. During the testing phases of accumulation, if volume remains excessively high on downward movements, indicating supply is still present and aggressive, the professional trader must maintain a smaller position size, awaiting definitive evidence that supply has been absorbed. Conversely, if a downward test occurs on significantly diminished volume and the subsequent rally is marked by expanding volume, this suggests demand has taken control. This definitive absorption of supply allows for a higher confidence entry and justifies the maximum calculated position size for that specific tight stop loss. If a potential spring occurs but is immediately met with heavy selling on the subsequent rally, supply is still dominant. The size of the initial entry must be kept small, recognizing the high probability of a subsequent deeper test or even a complete structural failure. The law of supply and demand ensures that the commitment of capital matches the immediate reality of the market's internal strength. The second is the law of cause and effect. This law connects the current trading range activity to the potential future movement. The size and duration of the accumulation or distribution structure, the cause, dictate the potential magnitude of the subsequent price move, the effect. This potential effect is quantified using horizontal point and figure charting methods. A large, long-duration accumulation base suggests a powerful imbalance is being created, promising a significant markup phase. Larger causes justify larger eventual positions because the potential reward derived from the point and figure count is substantial. This substantial reward potential provides the high reward-to-risk ratio necessary to validate the initial position size calculation. If the accumulation base is small, the potential effect is limited. In such a scenario, even if the risk is tightly defined, the trade may be dismissed entirely or the position size reduced because the potential reward does not adequately compensate for the inherent risk of the trade. The professional trader allocates their maximum risk capital only to those structures that promise a commensurate reward, as defined by the law of cause and effect. The third is the law of effort versus result. This is a critical risk management tool that provides real-time feedback on the validity of the structural analysis. If significant volume effort is expended without meaningful price movement, result, the structural integrity of the anticipated move is questionable. For example, if a sign of strength occurs following a spring, but the upward move stalls abruptly on high volume, it suggests that professional selling is re-emerging unexpectedly. The result, the price advance, does not match the effort, the high volume. When the law of effort versus result indicates resistance, the professional trader must react immediately by reducing the position size or moving the protective stop to the break-even point. This law acts as a warning system. A failure of result relative to effort signifies that the composite operator may be changing their plans, or that the market structure is not as strong as initially assumed. This failure requires a corresponding reduction in capital exposure. Position sizing must always consider the actions and intentions of the composite operator. The structure of the Wyckoff methodology assumes that the market is professionally managed, and the phases of testing are designed specifically to shake out weak holders and absorb supply at the lowest possible prices. The initial position sizing must therefore account for the possibility of a final aggressive shakeout, such as a deep spring below the selling climax low, or a pronounced upthrust after distribution above the buying climax high. These maneuvers are designed specifically to trip stops placed by less sophisticated traders. The professional trader must place their calculated stop loss outside the zone where such a shakeout is likely to occur and size the position accordingly. The size calculation must ensure that any single anticipated shakeout, even if it hits the calculated stop, does not violate the established risk tolerance for the entire trading account. If the account risk tolerance is set at 1% maximum loss per trade, the position size must be small enough that the distance between the entry and the logical structural stop equals exactly that 1%. This defensive sizing strategy ensures that the trader can survive the composite operator's manipulative tactics and remain solvent to participate in the confirmed trend. A crucial distinction must be made between capital allocated for proven, high-probability setups and capital allocated for early, speculative entries. This distinction is vital for maintaining disciplined position sizing. Speculative capital is allocated during the early phases of accumulation or distribution, phase A or phase B, where the boundaries are still being established and the final test has not yet occurred. An entry based purely on preliminary support or resistance or an initial secondary test carries a higher degree of uncertainty because the composite operator has not yet completed the absorption process. These early entries must use a smaller position size reflecting the wider, less defined risk parameters and the higher probability of failure or a deep shakeout. Risk capital, by contrast, is allocated for high-probability Wyckoff setups that occur in Phase C and Phase D. The classic example is the successful test of a spring in Phase C, followed by a decisive sign of strength in Phase D. At this point, the market has structurally confirmed that supply has been absorbed, and the risk boundary, the low of the spring, is clearly defined and extremely tight. These confirmed setups warrant a significantly larger position size, as the probability of the immediate move succeeding is maximal, and the defined risk unit is minimal. The professional trader understands that while the monetary risk, the maximum dollar amount lost, remains fixed, e.g., 1% of total capital, the calculated position size can be maximized due to the tight structural stop provided by the successful test. This strategic differentiation in sizing ensures that the largest capital commitment is reserved for the highest quality, most structurally validated opportunities, maximizing the expectancy of the trading strategy. The implementation of this strategic differentiation requires a rigorous analytical technique centered on defining the precise monetary risk unit. This definition is the bridge between the structural observation provided by the Wyckoff methodology and the disciplined execution required for professional trading. The cornerstone of prudent capital management is the fixed percentage risk model. The professional trader adheres to a strict maximum percentage of total trading capital that can be allocated to risk on any single position. This percentage is fixed and inviolable, typically ranging from 1% to 3%. The purpose of this stringent rule is the preservation of capital above all else. By capping the maximum potential loss on any trade, the trader ensures that a series of inevitable losing trades does not fundamentally impair the ability of the account to participate in future, higher probability opportunities. In this model, the risk percentage remains constant, but the resultant position size becomes the variable component. This variable component is derived directly from the structural analysis of the market action, specifically the distance between the entry point and the logical stop-loss placement. The fundamental calculation that governs all position sizing is straightforward. Position size is equal to the total capital multiplied by the fixed risk percentage, divided by the distance to the stop-loss, measured in dollars per share or per contract. This calculation enforces a mathematical discipline. If a trader maintains a 1% risk tolerance on a $100,000 account, the maximum monetary risk for that trade is $1,000. This $1,000 is the absolute limit of exposure. The Wyckoff analysis then determines how far away that $1,000 boundary must be placed in terms of price. If the structural stop requires a $5 distance from the entry price, the trader is permitted to purchase 200 shares. If, however, the structure dictates a $10 distance to the stop, the trader is only permitted to purchase 100 shares. This inverse relationship ensures that the monetary risk is constant, regardless of the volatility or the width of the trading range being analyzed. The critical input for this calculation is the definition of the stop-loss based on structural integrity. The stop-loss placement must not be arbitrary. It must be logical, positioned at a price point where, if breached, the fundamental structural premise of the accumulation or distribution scheme is definitively invalidated. For accumulation setups, the stop is placed outside the logical extreme of the professional's testing activity. The absolute lowest risk placement is often considered to be slightly beneath the low of the selling climax, as this point represents the final exhaustion of supply before the composite operator begins serious markup preparation. However, in Phase C, the highest probability entry is often triggered by a spring or a final secondary test. In these cases, the stop is placed slightly beneath the low established by that spring or the final secondary test low. The reasoning behind this placement is structural. The spring is executed by the composite operator specifically to clear out the last vestiges of supply and to test the market for remaining selling pressure. If the price penetrates below the low of that spring, it indicates that the selling pressure was not exhausted, that the composite operator has failed to secure the base, or that the structure is actually a redistribution pattern. In any of these scenarios, the premise for the long trade is broken, and capital must be preserved immediately. Conversely, for distribution setups, the stop must be placed above the structural high. The stop is generally placed above the high of the buying climax, or slightly above the high established by the upthrust or the final secondary test high. The upthrust represents the final effort by the composite operator to drive prices above the trading range to trap late buyers and to finalize their distribution. If the price moves decisively above the high of the upthrust, it implies that the demand is stronger than anticipated, the distribution failed, and the market is likely entering a further markup phase. The structural integrity of the distribution is invalidated, requiring the trade to be closed. It is essential that the stop-loss placement accounts for typical market spread, daily volatility, and the possibility of rapid shakeouts or overnight gaps. A small buffer must be added beyond the absolute structural low or high. This buffer is a necessary concession to market reality, preventing the trade from being stopped out by minor, non-structural volatility that is still contained within the professional's testing efforts. The calculation of the risk unit varies significantly depending on the specific Wyckoff phase in which the entry is taken. In Phase A or Phase B during the early construction of the trading range, the risk is typically wider, and the position size must therefore be smaller. The boundaries of the range are often undefined or subject to retesting. If an entry is attempted early in the range, the risk unit is defined by the absolute range extreme, for example, the automatic reaction high or the selling climax low. Since the distance to this stop is substantial, the mathematical requirement of the fixed percentage risk model mandates a significantly reduced position size. This aligns perfectly with the lower probability inherent in early phase entries, where the intent of the composite operator is not yet fully confirmed. Phase C represents the highest probability entry point within the entire Wyckoff scheme. This phase includes the critical tests like the spring in accumulation or the upthrust in distribution. Crucially, the risk unit here is the tightest. Because the spring low, for instance, is intended to be the final low, placing the stop just below this point minimizes the price distance to the stop. A tight risk unit, when combined with the fixed risk percentage, allows for the maximum calculated position size. This structural tightness is the primary mechanism through which the Wyckoff method optimizes capital deployment, reserving the largest capital commitment for the point of maximum structural advantage. In Phase D, confirmation often arrives with a clear sign of strength or sign of weakness, followed by a backup to the edge of the creek or a last point of supply support. These entries are slightly less aggressive than the Phase C entry, but carry a higher degree of confirmation. The risk unit is defined by the low of that final test or backup. While this stop distance may be slightly wider than the immediate spring low, it still represents a tight, structurally sound risk unit. This phase is often utilized for scaling into the position with confidence, as the market has decisively broken out of the range and confirmed the directional bias. The process of converting price movement to the actual share or contract quantity is the crucial mechanical step. First, the allowed dollar risk must be precisely calculated. If the total capital is $500,000 and the fixed risk percentage is 2%, The maximum allowed loss on the trade is $10,000. This $10,000 figure is the risk budget for the trade. Second, the structural distance must be measured. If the entry price is $50 per share and the defined structural stop is $45 per share, the price distance to the stop loss is $5. This $5 distance is the risk per share. Third, the calculation is executed. The allowed dollar risk, $10,000, is divided by the risk per share, $5. This yields a maximum position size of 2,000 shares. It is imperative that the trader internalizes the inverse relationship between the stop distance and the position size. If, in the same scenario, the structural stop was only $1 away from the entry price, the calculation would be $10,000 divided by $1, resulting in a 10,000 share position. The fixed risk percentage model prevents emotional overexposure by mathematically adjusting the size based on the quality and tightness of the structural setup. A professional trader recognizes that a wider stop distance necessitates a smaller position size to maintain the exact same monetary risk. This mechanism ensures that the trader is mathematically penalized for entering trades where the structural definition is weak or premature. The resulting position size calculation is only valid if the estimated potential reward justifies the initial risk taken. This introduces the crucial role of the reward-to-risk ratio. Wyckoff setups, due to their focus on identifying the exhaustion of supply and the beginning of a sustained trend, must demonstrate a minimum favorable reward-to-risk ratio, typically 3-to-1 or greater. A trade that offers only a 1-to-1 or 2-to-1 return relative to the risk taken is generally considered inefficient for professional capital deployment, regardless of the apparent probability of success. The potential reward is not estimated arbitrarily. It is estimated using the Wyckoff point and figure count methodology. The point and figure chart translates the horizontal dimension of the accumulation or distribution structure, the cause, into a minimum vertical price objective, the effect. The width and duration of the established trading range are measured to quantify the energy that has been built up by the composite operator. This quantification provides the objective target for the markup or markdown phase. If the point and figure count projects a target price that is $15 above the entry price and the structural stop is $5 below the entry price, the trade offers a 3-to-1 reward-to-risk ratio. This ratio validates the calculated position size and confirms the trade as being high probability and high expectancy. If, however, the point and figure count only yields a $5 potential movement, the ratio drops to 1-to-1. In this scenario, even if the structural entry, like a spring, is technically sound, the trade must be rejected because it fails the risk management mandate. The capital is better preserved for a setup that provides a superior reward-to-risk profile. The integration of the point and figure count ensures that position sizing is inherently linked to profit potential, not just risk limitation. The professional approach recognizes that the maximum allowable position size calculated by the fixed percentage model is only deployed when the market structure confirms both minimal risk exposure and substantial potential reward. This analytical process ensures that capital is deployed only when the market structure, defined by the composite operator's actions, provides a clear, objective, and quantifiable edge. The definition of the risk unit, therefore, is not merely a financial calculation. It is a direct reflection of the trader's understanding of the underlying market dynamics of supply and demand absorption. The mechanical execution of the position size calculation is only the prelude to effective risk management. The true mastery lies in the dynamic adjustment of that size as the trade evolves through the various phases of the market structure. This dynamic management begins with the critical distinction between the initial entry and the confirmation entry. The initial entry, often triggered by a testing maneuver like a spring in accumulation or an upthrust in distribution, carries a higher inherent risk. While these structural events offer the tightest possible stop-loss placement, they are, by definition, attempts to violate the established trading range boundaries. There is always the possibility that the test fails, leading to a structural breakdown rather than the anticipated reversal. Therefore, the professional trader typically sizes this initial entry conservatively. If the fixed risk model dictates a maximum total position of 1,000 shares, the initial entry might commit only 500 shares, or 50% of the calculated maximum. This staged commitment serves as a psychological hedge and a financial safeguard. If the spring fails, only half the maximum risk capital has been exposed, allowing the trader to maintain composure and capital for the next high probability setup. The confirmation entry occurs after the market structure has been validated. In the case of accumulation, this validation comes with a successful sign of strength followed by a crucial backup to the edge of the creek, or the last point of supply. At this juncture, the market has demonstrated its willingness to move away from the base, confirming that the composite operator has absorbed the remaining supply and is ready to mark up the price. When the price successfully holds the backup, the probability of a successful trade increases dramatically. This confirmation justifies the addition of the remaining position size. The remaining 50% of the calculated share quantity is added, bringing the total position size up to the maximum allowable based on the original fixed risk percentage. This two-part execution strategy ensures that maximum capital exposure is only reached when the market has provided definitive evidence of structural integrity and directional commitment. This staged approach is fundamental to capital preservation. It prevents the full force of the calculated risk from being deployed prematurely into a potentially ambiguous situation. It recognizes that even the best structural setups, such as springs, occasionally fail to deliver the expected reversal. By waiting for the market's confirmation, the trader aligns the full monetary risk only with the highest probability segment of the Wyckoff structure, specifically Phase D. Beyond the initial entry and confirmation, the concept of pyramiding dictates how position size is managed during the subsequent trend. Pyramiding refers to the practice of scaling into a winning position as it progresses favorably. This is a highly disciplined technique and must not be confused with the fatal error of averaging down, which involves adding to a losing position. Pyramiding is the strategic maximization of gains. Averaging down is a desperate attempt to salvage a failing trade, often leading to catastrophic losses. The professional trader adheres to strict rules when pyramiding. The paramount rule is that each subsequent addition to the position must be smaller than the preceding entry. If the initial entry was 500 shares and the confirmation entry was 500 shares, the first pyramiding addition should be significantly less, perhaps 300 shares. The next addition must be smaller still, perhaps 200 shares, and so on. The rationale behind this rule of diminishing size is mathematical and structural. As the price moves higher, the position is moving further away from the original base of accumulation. This means that the distance to the logical stop loss, which remains tied to the structural low of the base, is increasing relative to the current price. Consequently, the cost basis of the overall position rises with each addition. By ensuring that subsequent additions are smaller, the trader prevents the rising cost basis from eroding the overall profit buffer too quickly. The goal is to maintain a low average cost across the entire position, thereby maximizing the potential for large profits on the bulk of the shares. Furthermore, pyramiding should only occur at structurally significant points, such as successful tests of breakout levels or pullbacks to the established trend channel. These points must offer a renewed, favorable reward-to-risk ratio. If the estimated remaining profit target, derived from the point and figure count, does not offer at least a 3-to-1 reward-to-risk ratio on the new, smaller entry, then the addition is not justified. A critical risk management technique employed during successful pyramiding is the movement of the stop loss. Once the price has moved significantly beyond the confirmation entry and the position has been fully sized, the stop loss for the entire position can often be moved up to the entry price of the first unit. This maneuver effectively creates a risk-free trade on the initial size, meaning that the worst-case scenario for the initial commitment is breaking even, thereby preserving the capital allocated to that segment. As the trend matures and the price moves substantially higher, the stop loss is systematically trailed. This trailing stop should not be arbitrary. It must be based on the market's structural action, typically placed below the low of the most recent significant reaction, or below the established trend channel line. This process locks in realized gains while still allowing the position to participate in the ongoing uptrend, transforming paper profits into secured capital. The scope of position sizing extends beyond the single trade. It must encompass the entire trading account and the portfolio's exposure to systematic risk. A significant oversight made by less experienced traders is failing to account for asset correlation. If the fixed risk percentage for the total trading account is set at 3% maximum exposure across all open positions, opening 3 separate trades, each risking 1%, appears mathematically sound. However, if those 3 trades are all in highly correlated assets, for example, 3 different semiconductor manufacturing stocks, they are essentially reacting to the same underlying market forces and sector news. If the semiconductor sector experiences a sudden adverse event, all 3 positions are likely to fail simultaneously. In this scenario, the trader has not risked 3 separate 1% units. They have risked a single, highly concentrated 3% unit. The professional approach is to treat highly correlated positions as a single risk unit in the position size calculation. If the total allowable portfolio risk is 3% and the trader decides to enter 3 correlated technology stocks, the risk must be distributed across the group. Perhaps the total monetary risk is defined as $3,000 if the account size is $100,000. This $3,000 must be split among the 3 positions, meaning only $1,000 is risked per position, ensuring that a systemic failure does not breach the portfolio's overall risk tolerance. Diversification in the Wyckoff context means seeking out high-probability setups across different, non-correlated market sectors. A healthcare stock in accumulation phase C, an energy commodity in a clear distribution scheme, and a financial instrument showing signs of a strong markup. This minimizes the chance that a single economic or political shock will invalidate the structural integrity of all open positions simultaneously. The ultimate measure of successful position sizing and risk management is the trading expectancy. Expectancy is the mathematical edge of the trading system, defined as the average amount a trader can expect to win or lose per dollar risked over a large series of trades. A positive expectancy indicates a profitable system over time. Expectancy is calculated by multiplying the probability of a win by the average dollar gain, then subtracting the product of the probability of a loss and the average dollar loss. High-probability Wyckoff setups are specifically designed to maximize the win rate and the reward-to-risk ratio, both of which are critical drivers of positive expectancy. By insisting on a minimum 3-to-1 reward-to-risk ratio for every trade, the system is engineered to absorb multiple small losses, while ensuring that winning trades deliver profits large enough to cover those losses and generate a net gain. Proper position sizing is the mechanism that translates this theoretical expectancy into realized profits. If the trader identifies a setup with a 4-to-1 reward-to-risk ratio but takes a position size that risks 10% of the account, a single loss invalidates the positive expectancy for dozens of subsequent trades. Conversely, adhering strictly to the 1 to 3% fixed risk model ensures that the mathematical edge inherent in the Wyckoff structure is preserved and compounded over time. Regular calibration is necessary to maintain the integrity of the risk model. The professional trader must review realized risk versus calculated risk. Were the stop-loss placements consistently breached by only a few ticks, or were they fundamentally misplaced? If the stop-loss is consistently hit before the anticipated move begins, it suggests the structural definition of the accumulation or distribution scheme was flawed, or the buffer placed beyond the structural low was insufficient to account for volatility. Calibration involves refining the stop placement strategy to ensure that the risk unit is truly defined by the point of structural invalidation, and not merely by random noise. Position sizing is equally critical on the distribution side, that is, the strategic management of scaling out and profit realization. Just as size is added strategically during the accumulation phase, it must be removed strategically as the price approaches the point-and-figure count objective derived from the original base. Selling the entire position at the first sign of weakness is often premature, resulting in missed profits. Conversely, holding the entire position until the market structure collapses exposes the trader to unnecessary risk and the eventual erosion of paper profits. The professional strategy involves scaling out in stages as the price extends and approaches the calculated target. The point-and-figure objective provides a clear quantitative target zone. As the price enters the lower end of this zone, the trader may elect to sell 25% of the position. This action immediately locks in a substantial portion of the profit, reducing the overall monetary risk of the trade. As the price moves higher within the target zone, perhaps reaching the midpoint, another 25% is sold. This continuous reduction of size ensures that the profit is preserved, aligning with the primary mandate of capital preservation. The remaining 50% of the position is maintained as the core position. This core position is held until there is definitive structural failure, such as an upthrust after distribution, a clear break below the established trend channel, or a failure to make a higher high on significant volume. The purpose of the core position is to capture the final, often rapid moves characteristic of the climax of the markup phase. By systematically reducing position size as the market becomes extended, the trader transforms the theoretical effect, calculated by the point-and-figure method, into realized capital. This process manages the risk inherent in a mature trend, where volatility increases and the probability of a sharp reversal grows. Position size reduction is fundamentally a form of profit preservation, ensuring that the capital generated by the successful trade is safeguarded from the inevitable market correction. The mechanical application of position sizing, stop-loss placement, and risk calibration is only half the equation for long-term success. The other, equally vital half, is the psychological and business discipline required to execute these protocols flawlessly, without succumbing to emotion or temptation. This philosophy of treating trading as a serious professional business, rather than a speculative pastime or a form of entertainment, was the central, non-negotiable tenet of Richard Wyckoff's teachings. The very necessity of rigorously defining the risk unit and adhering to strict maximum loss percentages is rooted in the realization that capital preservation must always override the desire for immediate, aggressive profit maximization. Wyckoff emphasized that the fatal error of nearly all retail speculators is their failure to limit risk, often leading them to engage in ruinous practices like averaging down on losing positions, which directly violates the principle of structural stop placement. The discipline required to place a logical stop loss, and crucially, to honor that stop loss when it is hit, is the difference between an amateur and a professional. For those seeking to master the discipline necessary to adhere to these strict risk parameters and to understand the market from the perspective of the composite operator, the foundational text outlining this entire business philosophy is essential. Wyckoff's own work, How I Trade and Invest in Stocks and Bonds, adapted by Max Davidson, details precisely why the techniques of position sizing and stop-loss placement are non-negotiable elements of the trading business. It provides the psychological framework necessary to ignore noise and tips, focusing solely on the market's own action, the price and volume, which is the only reliable guide for determining where structural risk lies. This book serves as the master blueprint for the professional trader, linking the technical analysis of market structure directly to the practical, disciplined management of capital. A link to this foundational text is provided in the description below.